it's been some interesting presentations, everything from bond issuances and structured finance to really interesting application of cancer discovery. This is again a bit more left field. We're in the mineral sector now. So what does Cadence do? It says it on there, we're a partner and investor in the discovery and development of strategic metals. I'll go a bit more in detail on that after this. This is a disclaimer. We all have them. They're there for they're there for a reason, so please read them at your leisure at a later date. So what is our strategy and where are our key investments? We invest in and develop world-class assets in the battery sector. Now, when we say the battery sector, we mean the metals associated with what is occurring at the moment, which is the EV revolution, the change of way that we will transport ourselves over the next 10 to 15 years. We have really two pots, and the second pot has sort of developed over the last 6 months, two pots of investments. The first is private assets, where we take up to 100% of those assets, and we work with management and become part of management, and we try to drive value through the steepest section of the value curve, which is basically from early exploration all the way to an economic outcome, i.e. a pre-feasibility study or a scoping study. We also have a public company investments where we've invested historically since around 2013 in taking significant economic stakes, which have been diluted along the way, in assets that have also gone through that stage and are now coming up to production. So, you know, those assets include those two there, which is European Metals Holding, where we hold 21%, and Bacanora Minerals, where we hold 7%, and we have a joint venture with them at 30%. Both of those assets, you know, Bacanora is building its assets this year and will come into production of a lithium carbonate in the following year. And we've used a combination of the expertise of management and consultants to identify assets, which is really about company picking, yes, understanding their strategic advantages, and I keep on going on about it, so being about in the lowest cost quartile, because if you are in the lowest cost quartile, despite any change in commodity prices, although lithium carbonate isn't a commodity, you're really going to be protected against downside. And also we look for assets that are mispriced. I take both of those as an example, both Bacanora's and European Metal Holdings, because Bacanora is a clay-type asset, and generally people didn't think it would be able to produce lithium carbonate. We went out to site, we looked at their pilot plant in 2014, and they really have progressed really well, so much so they've got Hanwha as an off-take partner, and have really developed this as a stunning project. European Metals wasn't considered because no one really looked at the tin credit. That tin credit drops that cost down quite dramatically. And consequently, you've seen that through those public entities, we've shown some fairly reasonable returns on a cumulative basis over the last 2 years of our investments. The private assets really are, is actually the Mexlit JV and the San Luis project in Argentina, which we got involved in December last year. So, you know, I'm talking about lithium, and we're seeing a lot about it. We're seeing Volkswagen, we're seeing everyone talking about they're building gigafactories, mega factories, you know, lots of new vehicles coming out. But is this all hyperbole? Is this sort of, you know, something that's really not going to occur? So we go from an evidence-based approach and look at history, and what we're really seeing is that the speed of the penetration of electric vehicles has been completely underestimated by the market. Even by the the sort of reporters and television, etc. And the rate at which the industry, i.e. the lithium market, i.e. the producers of lithium, i.e. the mines, coming to meet that lithium demand is much more linear. So where do we get this from? I mean, this is a statement, as you can see, from the president of Michigan Savings Bank, Henry Ford's lawyer, who said, basically, don't invest in Ford. And you can sort of understand, I mean, it looks silly now, but you can understand his environment, his sort of understanding where he saw that. From his view, he looked at, I think it was Easter Day Parade in 1918, New York, and you couldn't spot an automobile. The automobile is the one highlighted in red. But 10, 15 years later, it's changed completely. Effectively, the horse-drawn carriage is dead, that business model is gone, and you are replaced with the automobile. And when you see some things occur, and it's throughout history, whether it's through the printing press, whether it's through television, whether it's through planes, when you see several key aspects occurring, you will see a disruptive technology. And the electric vehicle really does tick all those boxes. It has, really, and this is from a guy called Tony Seba, who has basically analysed everything from the printing press all the way through to MP3 players, colour TVs, and seen similarities across the board. And effectively, one is the technology cost curve. Are costs getting cheaper at an exponential rate? So if we look at battery technology, we had an interesting conversation talking about battery technology. Look, 2005, it was $1,500 a kilowatt hour. It's probably sitting around now, this is a bit of an old graph, at around the $200 a kilowatt hour. That's a 5x, and people are talking about at least a 10x improvement in battery kilowatt hours, the cost per kilowatt hour. Coupled with the electric motor, which is improved, coupled with things like transport as a service, you will start to see that the overall cost imperative to be about a 10x improvement. And every time you see a 10x improvement throughout history, you see disruptive technology. You see penetration rates just going off the scale, from it being 1% to in 10 to 20 years being 80%. So these are the things that are driving, I suppose, people like, will eventually drive why we will be effectively driving the EV forecast. Taking from Tony Seba, he looked at these cost curves and looked at where the average, and I think the most important one, this is all US-based, average low-end car would hit about 22K, and that's when basically it makes sense, not on a total cost of ownership basis, but on a purchase basis, make it cheaper just to buy an average low-end car, electric vehicle than in any other. Considering that there's no maintenance costs, it's 5 times cheaper to charge, we could go on. And people have forecasted various sort of penetration rates and the EV sales per year, some a bit more conservative. The most aggressive that we can see out there is UBS. They took apart Chevy Volt and said they realized that it was already cost-effective to own an electric vehicle. And that is nowhere near what Tony Seba would suggest. He would just suggest a vertical takeoff around there. So even with that, we still have about 23% penetration on new car sales. So what does that mean for what we're concerned about lithium carbonate? Lithium carbonate, or lithium hydroxide, is the mineral that is used in lithium-ion batteries in electric vehicles, and more and more so in energy storage. Notice I'm not talking about energy storage here because this is the easiest one to get some transparency on. So it generally looks like supplies to remain strong based on the EVs. We have a demand total, and I talk about tons of LCE per year. So at the moment, we're doing about 200,000 tons of LCE per year in terms of demand. And that black line is the demand curve based on those EV sales. And this is our own assessment of the supply curve. So we look at each project that is out there. We assess it on the basis of risks and understand which ones are likely to deliver or not. So we can see a balanced or a slight surplus there, but effectively, generally, it's a deficit out into 2023 to 2025. And that really shows a really good supply and demand curve. And lithium carbonate prices have, there are actually around $16,000 a ton at the moment, and in China around $20,000 a ton. I think most people are suspecting that there'll be around $11,000 a ton in the long term. But there's a strong fundamental driver for good lithium carbonate prices. And just as a point of note, those two assets that we have invested in, they're going to be producing around 55,000 tons of lithium carbonate per year, which in the scheme of things is quite a significant amount, even when they come to production. So bearing that in mind, there is a favourable S&D curve. There's an exploration space that's underdeveloped. There's plenty of lithium out there. Let's not make no bones about it. But it's identifying the right assets, right cost curves, right management, right location, and if you find therefore there are investment opportunities. So what I'm going to go through now, try to do that in as brief time as possible, is effectively go through the two pots that I talked about. The first is the projects, and focus on our Argentinian lithium asset that we've recently got involved with, and also then I'll look at some of the investments on sort of a value basis rather than the detail behind them. You can always see that on our website. So the projects that we have, as I mentioned, we have others like the JV with Sonora, but this one I'm talking about are Argentinian lithium prospects. Why we liked Argentina is mainly because of, well, first of all, it's a very well-known lithium producing country, mainly for what we call brines, but they also have the pegmatite zones, which these are the mineralized, or these are the ore bodies that carry the mineralized spodumene. So they have huge pegmatite province in the San Luis area. There are several others there, people like Dark Horse Resources and Latin American Resources who have got concessions. We've decided to earn in, which is a sort of a risk-averse way to do it, because effectively we're only on success on certain things being achieved, identifying a drill target. Do we have commitments to put in further cash? And we earn in to effectively up to 100%. And that would be for an overall consideration of around £3 million, of which 1.1 million would be in cash in the ground, and the rest would be equity in the company. It's a very large concession, set of concessions in a very prospective area. We've got historic mines that have produced 4.5 to 6.5% lithium oxide. Now, take that with, those are historic mines, they're historical estimates. Typically, a very good lithium, sort of hard rock lithium oxide mine or spodumene mine would be about 1.5. So I don't think we would be getting 4.5 or 6.5, but it shows that there has been production there. Not much, but there is mineralization there, which is important, because not all pegmatites are spodumene or mineralized. It really depends. They have to be in a certain zone, what they call the LCT, lithium, cesium, tantalum zone, and that's how they're differentiated away from the granite. So we really like this as our sort of our focus of getting involved and putting boots on the ground and drilling, and that's what we'll be going to be trying to do over the coming year. Q1 this year we'll have boots on the ground, mostly prospecting, and that will be really, I mean, these actually, you can see the pegmatites are at surface. These long stringers and veins going across the picture are at surface, and we'll be mapping all of them, and there's a lot to map. And we'll be putting several teams on the ground to map, identify if they've got spodumene, and once we've got that and the prospecting license is granted, we'll then start sampling, and we'll getting results from that and determine a drill target. The idea is to start drilling in H2 this year. If we have something substantial, with fingers crossed, you could possibly talk about a maiden resource. But the idea is to get a maiden resource, and then we can sort of assign some value. And this is, you assign value. Often people use a EV per resource, so it's a US dollar per EV per resource valuation. So that's a producing operation. That's why it's valued at $1,000 per ton of resource it's got in the ground, and some of these others are in various stages of development. But they're all hard rock spodumene type deposits. So if we find the right asset and we manage to target something around 25 million tons, 1.2 LiO2, you could end up with about 750 kilotons of lithium carbonate equivalent, and that would, based on a weighted average of these figures, you would have about an enterprise value of about 300 million there. So there's plenty of upside. It is risky. It's early exploration, but we've hoped through our experience and an understanding of these deposits and understanding of the lithium market generally, that we've definitely picked the right country. It's in the right province. It's got a lot of other assets around it that have historically produced lithium carbonate in some form, and really it will be about seeing if we can identify a resource there. But that's, I suppose, one part of the upside for Cadence. When we look at our investments, we have effectively, this is, I suppose, this is the performance of our listed investments to date. Our idea here was certainly to try and beat the lithium index, which is including producers as well. But certainly our cumulative returns have fared well, and we're about even with the lithium index. We've obviously got more volatility, more beta because of we've got smaller capital availability to expenditure, so we've got about 3 or 4 assets involved. So this was European Metals going through a very strong run prior to its pre-feasibility study being released. So the value proposition across these assets is, if we look at what we've invested to date, you can see there, European Metals, we bought shares in the market, we invested 19 million. The current value is around 10 million. And Bacanora, we've got the Sonora lithium asset, which we've got a JV on, which will be mined later in the mine schedule, but nonetheless has a value, and the shares that we bought. So you can see that even under current circumstances, where we're seeing about a market cap of 20, if you take our unlisted assets, there's no value attributable to Argentina here at all. We have, there's still value in there. There's 36 million pounds worth of assets, as it were. Our balance sheet will probably show about 31 because we have 21% of this, and as soon as you go over 21%, it becomes an associate, so you don't get any fluctuation in the share price. And what about the growth? Well, if we retained our equity stakes in these assets, they've all got some economic values around them. So the PFS of European Metal Holdings is about 550 million. Bacanora had an amazing feasibility study of 1.25 billion, internal rates of return in excess of 20%. And obviously we would expect to be diluted along the way, but assuming no dilution, there's some potential upside there for us as well. So, what is important about Cadence. So I actually wanted to show you, this was European Metals Holding. It's a lovely slide of showing its strategic location. It is really in the heartland of where electric vehicles are going to be purchased. And I remember having a conversation with, it was Daimler about 2-3 years ago when we went around a tour. And they really didn't want to, Daimler's and Mercedes-Benz's IP is really their drivetrain. That is where their IP, a lot of the rest of it's outsourced. So it was really important that they keep that. So they're now really starting to be committed in terms of battery plants, whether it be LG, whether it be Northvolt, all having battery plants in Europe. So then, therefore, having a source of lithium carbonate in the middle of the Czech Republic is an important part of that supply chain. And I think European Metals Holding will be an important part of the supply chain for European car manufacture going forward. So, in summary, I believe, and we believe, the company is poised for upside. It's got a current market cap of 20 million. It's backed entirely by its equity stakes. There is considerable value yet to be attributed to the unlisted projects, and this specifically in Mexilit and, if successful, Argentina. And we have assets that are of a large scale. They are world-class in the ones that we've invested around the world. And I think we have strong news flow from Sinovac, Sonora, and the exploration activities in Argentina. And we're part of a market that is growing incredibly quick. 20 to 40% compound annual growth rates within the EV market. And that will ultimately show, that's why you're getting a 5x or a 7x improvement in lithium carbonate demand. I mean, really, we're going to apply what we've applied beforehand in our wholly owned assets, is to really leverage the skill set of management, our contacts, our understanding of the market, because lithium carbonate is not a commodity. It is a traded mineral, and it is about understanding who's going to buy your material. Do you have the right quality? Do you have the right contacts within the various spodumene converters in the case of Argentina? And it's really important we'll leverage those contacts to particularly try and fast-track Argentina. So I think that's a fair summary of it. The team, well, that's who we are. But mainly it's a mix of technical and hedge fund and fund management background. And we're all vested, or we've committed to vest into the company over the coming year. And all our incentivization, well, any equity incentivization is based on share price performance. There's another disclaimer. I think our lawyer keeps on asking us to put disclaimers in the back. Thank you.
Any questions, anybody? No, you fire away. Oh, there's one behind, one in front of you first. Yeah.
Thank you. I just wanted to know what the life of the mines were, and what the cost of restoring the landscape, and also, whether any other minerals are found in the same locations?
So let's look at the ones that are closest to production, which would be the Sonora Lithium project. So it's primarily lithium. They will, as part of the process, which is not to do with what's inside the ground, as part of the chemical process of producing lithium carbonate, they'll produce a potash. And so they mainly, it's just going to be lithium. There won't be any other credits within the ground. The price, so what was the other question? So that it was also, what was the other question?
The cost of restoring the landscape.
So that would, so actually it would, it's a minimal cost on the NPV. So at the end of the life of mine, you would restore it, or you would restore it as you go along. So it's not, it won't be a significant amount. You're talking about on an aggregated basis about $1 to $2 million a year.
Right, because the landscape looked very scarred.
That's natural.
Yeah.
So it's natural. That's the way it is, and hence the great advantage of it, because that has exposed all the mineral wealth for Bacanora at the surface. And the life of mine, both of those life of mines, once you go past 20, the NPV value is irrelevant to the future value. So they have resources that probably could last, in each case, 60 to 80 years, depending on mining rates, but they only do an NPV on 20 years because it's pointless after that.
I think there was a slide at your very beginning with a very deep mine, I think the one you're referring to.
Oh, no, those are not ours, sorry. I just say
that's what it could look like in 20 years.
It could look like in 20 years, yes.
Since you're looking to go into Argentina, I mean, the obvious question that comes to mind for me is how are you going to manage the currency risk, since the peso is probably, currency is bombed worse than sterling.
So,
just you're getting money in and out of the country, it's not easy, and that sort of thing. How do you manage it?
So at the moment, our partners in Argentina are Argentinian, and they've been involved. It's a company called Condor Resources and they've got an Australian ownership as well. So they've been involved in taking money in and out for exploration purposes. And part of the test that we did was making sure that we could transfer over $2 and making sure things that could come in quite easy and not get caught up in foreign exchange issues, because that's also critical for exploration. Because the last thing is you want a driller stopping because you're unable to pay, a $20,000 bill. So we're partnered with people who've done it before and do it a lot, and we've also run our own tests in terms of moving currency across. Now, in terms of FX risk, a lot of the majority of the contracts when you're doing exploration will probably be US dollar based. Certainly drilling contracts are US dollar based. So what we will do is, once we've defined that program, and there is a drilling program to be defined, we will effectively take a portion of our pound sterling and put that into US dollar and hedge it out straight out. We're not going to create any fancy collars and everything like that. We'll just take, so to remove that risk in terms.
You're not going to be buying pesos, basically.
There will be peso expenditure.
Yeah, not on a huge.
Not as huge, because obviously local exploration geologists, etc. You'll try to minimise exposure, and that happens in Africa. It happens around the world where you just have your contracts denominated in US dollars.
Can I just ask? I mean, you mentioned Condor Resources there. I think they
different company.
Yeah, I know that. You mentioned they had sort of interest in that area.
Yeah.
And I think they had a tie-up with Mariana Resources, who've now been taken over and got rid of the Argentinian assets that they had.
Yeah.
This isn't one of Mariana's.
No, this is a different Condor Resources completely.
Right.
Sorry, there's a Condor Resources, which is a public listed entity here, and this is a Condor Pty Limited based in Argentina.
Right. Okay. Thanks.
Any more questions, anybody? Well, I've got a gentleman just there. That's good.
Hi. I just wondering what your views are on the current share price and the fact that it seems to be slowly declining for quite a while now.
So if we look at the share price, say from April this year, I mean, there is a period before that where it was a fairly steep decline when we effectively had a very high premium over the asset base, and I think the market obviously realised where our asset base and brought us down to that. And so the April to now, that really has been about some fluctuations in the underlying assets, and we monitor that on sort of a weekly basis, and sometimes we're £2 million premium, £3 million premium to underlying assets, and sometimes we're 2 million. So it's really to do with the correlation, and we're correlated about 0.8 to our underlying beta. So the beta is about 0.8, so we're very well correlated to underlying assets. So it is to do with partly the underlying assets. And we had a spike at the tail end of last year, went up again, and then it's come off again as some of the lithium stocks, because of a bit of panic selling on the basis of SQM entering the market with Argentina again, Chile again. There was a buying opportunity, in fact, in some of the assets. So it's always, at the moment, it will be based on the underlying assets. What we expect to be able to do is try and show that, when I looked at that slide, is try to get that sort of define a resource in Argentina and create value for ourselves on our own, rather than be reliant on the underlying assets, and utilize, delivering value out of those underlying assets and funding our own projects. So ideally, not going back to shareholders for money.
And companies like yourself in the exploration area, particularly ones where Donald Strang's involved, finance director, quite choppy, react to news flow. What's your news flow like for the rest of 2018 as a business? What can shareholders potentially look forward to?
So the main news flow that we could see is, so the Argentinian one I sort of highlighted where we could see news flow, which is ultimately going to be about sampling results from ground and then drilling. Whether we achieve a maiden resource in this current this year will remain to be seen, but certainly within a year I would hope from the start of prospecting to get a maiden resource. So that will be under our own control. I think what we're really going to see on the two underlying assets, value creators, value drivers, is that Sonora will get funded. Once it's funded, construction will start, and then so that will be construction all the way through 2018 and 2019. It's a big plant, and production or dry commissioning in 2019. So there'll be news flow from that. And I suppose the European Metals will be about starting its bankable feasibility study, getting into the nitty-gritty of defining the economics of that. I've always said that EMH is about 1 year behind Bacanora, and so I can see the same value trends again. So EMH is a bit of doldrums at the moment. As soon as it gets its bankable feasibility study, hopefully with improved economics, you will see that will be a value driver for us as well. So,
and new opportunities, do you think you'll be announcing new investments during the year?
We are on the lookout. We're conscious, and much like I think the previous one of the previous, we don't want to let cash reside. So, for example, what we have done, although not material, there's some cash that was resided. We took an opportunity to invest in some of the major players in the lithium market because there was a buying opportunity. It came off, and that's already making a reasonable return for us.
That's possible then?
Possible, yeah.
Good. Thank you very much, Kiran.
Thank you.